Welcome to Alpha Wolf Trading. Did you know that there's over 12,000 stocks or companies that trade on the OTC? Between the NASDAQ and the New York Stock Exchange, you have over 7,000 companies. But us as retail investors, we wouldn't know that unless we were researching. Because why? Wall Street focuses on the elite, the big companies. And where the retail investor has their advantage is in small and micro-cap stocks. Why? Because you have the opportunity to speak directly with leadership. That is what this is all about here at Alpha Wolf Trading. We're trying to find the hidden gems, and we interview the executive teams of companies that we think meet the parameters to be those hidden gems. I also want to make sure you understand that this is not a paid-for promotion. I collect no compensation for the interviews I do here. These companies that I interview have been identified as potential opportunities for me and the members of Alpha Wolf Trading to receive a higher than average return on our investment. These companies I have identified either because of a technical setup on a chart, a fundamental change within the organization, new management team, new products, all kinds of different things that actually lead me here. But what do I think is the most important? Leadership. And that is why I do these interviews. I want to understand what drives the person that is leading the charge. I want to feel their passion. I want to understand their vision and the strategy that they're going to use to achieve success. That is what these interviews are for. I want to understand the share structure and the cap table, the size of the TAM, the total addressable market. This is the opportunity to learn all of those things. So sit back and enjoy. And if you learn anything from today's interview, do us a favor. Subscribe to the Alpha Wolf Trading YouTube channel. Hey, what's happening, everybody? It's Tim from Alpha Wolf Trading coming at you with a brand new company, not brand new in terms of new to the markets, but brand new for Alpha Wolf Trading. I met Marc. I want to say, Marc, we met a year and a half ago, maybe?
About a year and a half ago and a couple of times after
that. And I liked your story back then. Of course, the market kind of did its thing, and sometimes things slip through the cracks, and I didn't have the opportunity to do the interview. Now we've come around. We just saw each other not long ago and said, we got to do it this time. And so here we are. And, I guess I could look at this one of two ways. It would have been nice to hear from you prior to the 175 to $5. But it's pulling back. And it looks like it's going to try and test maybe the support area. We'll see. Right now, you're testing the, what is that, the 50-day? 40-day. You're testing the 40 EMA right now, that yellow line, as potential support. And we'll see what happens there. Just looking back on the chart. Let me see here. Oh, come on. Looking back on the chart, what do we got? So, a very interesting development here. Says you were in a long-term downtrend from about 2021 till 23. And to break a long-term downtrend is a pretty significant deal, right? Technically, for the technical guys. And to be doing that in an economy or in a market where the small caps have been under a lot of pressure for 24 months or so is pretty impressive, right? Yep. And you did it on significant volume. So, what is it indicating to me? It's indicating to me that this may be the beginning of a new long-term trend, right? Last one lasted from 21 to 23. Maybe it lasts 2-3 years going the other direction. So, yep. Marc,
How do I pronounce your last name, Mark?
Benathen.
Okay, Benathen. All right. I want to make sure I got it right. From LifeMD, the CFO, ticker symbol is LFMD. Thanks for coming in and telling us your story.
Yeah, absolutely. Thanks for having me.
So let's start out with what exactly in a 50-second pitch. What does LifeMD do?
Yeah, so LifeMD is a national direct-to-patient telehealth company. We operate in three segments. So the first one is lifestyle healthcare, and that's everything from men's health to sleep treatments, allergy, dermatology, and hair loss are the main areas. Second area, which is, that's a steady 20 to 30% growing segment per year. Second area is virtual primary care, which includes a weight loss program that we launched in the second quarter. And that does everything from concierge-based one-on-one primary care, where you have an actual relationship with your patient. 95% of our revenue comes from recurring subscriptions. We have long-term relationships with our patients. We treat them holistically in primary care. We essentially act as their primary care doctor. It's not episodic, urgent care where you have no relationship. Our physicians are our own physicians. We're not using 1099s. And within the primary care, we also have a weight loss program that we launched in Q2, which is also a phenomenal start, and very different than a lot of players out there that just sell GLP-1s. We're not selling the GLP-1. We're providing holistic primary and physician services to our weight loss patients. So that includes everything from the doctor visit to the lab work to diagnostics, which oftentimes gives us a purview into a lot of other issues that these patients have, and we can holistically work with them. And we also help them obtain approvals for GLP-1s and appropriate drug treatment if, of course, appropriate. And then the last piece is enterprise partnerships. We have some very significant partnerships currently going on in the weight loss space. You may have seen that we have public websites and trial programs going on with Nutrisystem and Octavia. We have a program with Health Warehouse where we help support their 1 million+ patients that they provide drug fulfillment for, as well as contracts with several pharma companies. A lot of the enterprise area feeds into primary care. And then lastly, we have a legacy investment that we were one of the initial seed investors dating back to 2018. It's non-core to the healthcare business. It's called Work Simply. It's self-run. We own 74% of it. It's a business that has a couple 100,000 subscribers worldwide in the workplace and document services world. And essentially, it's a cash machine that throws off cash to the company. We essentially can utilize that on a completely non-dilutive basis to invest back into the core business. Financially, we're going to do about 150 million in revenue this year. We're growing about 25 to 30+% a year, with the potential, frankly, with the weight loss expansion to grow 50+% a year. We've guided this year to doing 12 to 18 million dollars of adjusted EBITDA. We lost 15 last year and we lost 38 the following year. So we're not only growing, but we're becoming immensely profitable. And we're obviously in a massively growing TAM that's largely recession resistant.
I was just going to say that. I mean, regardless of what the economy does or what, the Fed does, it's not really going to impact your business, right?
Not at all. Not at all.
So people are going to still want to try and lose weight and get in better shape. I do think that there is a general trend in that direction, right?
Yeah. And look, general healthcare needs everything that we treat or that, we follow you for in the case of primary care. It's recurring in nature. We are in that type of recurring subscription business, and that's what our model is. It's one of the reasons that it's become so predictable and it's starting to become very profitable.
So you're essentially, and I don't want to throw out a competitor's name, but you're like a teledoc, right?
Yeah, very different than a teledoc. Look, teledoc is telehealth, but what teledoc does is they contract with an employer, a large-scale employer or an insurance plan, and they have an army of 1099 doctors that are not their employees. And essentially, you take an urgent care visit. with one of those employees. That's how Teladoc essentially gets paid, and obviously through those contracts. There's no loyalty there. There's no retention in that model, and it's largely commoditized. In our primary care model, essentially what's happening is you have a one-on-one relationship with the physician and their team. We have about 200,000 active patient subscribers today. That person stays with you throughout your time with LifeMD. Obviously, you have physician support staff, and we can handle the full swath of your healthcare needs. We have integrations with Quest and LabCorp. We're a national partner of choice for them in direct-to-patient healthcare. We have national pharmacies fully integrated with us for our own pharmacy discount program. So we're basically offering you all angles of healthcare, and we have it's relationship-based care. It's not commoditized urgent care visits. That's not what we do.
So if somebody, is it through only insurers? Like, what about somebody that
So we're all cash pay. We go direct to patient. We don't take insurance today. We are filing to take insurance in the primary care business. That'll probably be ready by the end of this year, which we think is going to really open the spigot for us. We're also going to take Medicare after that as well. We're going through that process. But today we've built our business and are going to continue to scale as 100% cash pay. Taking insurance in primary care is only going to make it that much better. The lifestyle businesses and the weight loss business within primary care, insurance doesn't matter because it doesn't typically cover those treatments anyway.
Right. So the lifestyle business, I'm thinking like Hims and
Yep.
Right. Okay.
Yeah. So Hims is more consumer focused. They will do things like, they manufacture their own brand of condoms and things like that. We don't do that. We're true healthcare. They're more consumer focused. They're a great company. They've done a very good job in doing what they're doing. But yeah, we compete against them in things like sexual health, hair loss, stuff like that. We take a more clinical approach. They're obviously more consumer in nature.
Approved in all 50 states?
We are. We actually have a 50-state telemedicine network. We have doctors that cover all 50 states. Not every doctor is. We have some doctors that are 50-state licensed. Actually, 70% of our physicians are 35-plus state licensed. We have some NPs, also nurse practitioners. And we have patients in almost all 50 states, about 48 of the 50.
What do you, just out of curiosity, I mean, if you have it, maybe it's all over the place, but what's the average visit run?
Yeah, so it depends. So in the lifestyle business, you don't pay us for the visits. You pay us for the prescription treatments. So essentially what happens there is you go on a recurring subscription for, say, erectile dysfunction medication. And you get generic Viagra, and you're on a 3-month subscription. You'll get billed every 3 months for your supply. You might pay us $150 or so every 3 months, maybe a little bit less than that. Depends on dosage and exactly what you're doing. That'll cover you for 3 months. You're not paying for the physician visits. Most of those businesses are done what's called asynchronously, meaning the doctor reviews your medical records in full. In some states, they may have a brief consult with you, depending upon state regulations, and you can receive a script for up to a year. You can obviously check in throughout the year with your physician, but it's not a sort of a very high touch type of environment. Primary care being a little bit different. Primary care, you pay us for the doctor services, and that starts as low as $39 a month for the basic plan. You get 1 visit per month included. After that, you pay $49 a visit. We have a premium plan where all your visits are included. That's $99 a month. And then we offer urgent care, but it's not most of our business. We have a few percentage points of our customers, our patients that do for $139 a day an urgent care visit. The economics are really strong. We tend to break even on our ad investment in 2 to 5 months after we make it. And in the first year, we get a 2 to 2.5x return on our ad investment, including that's all returns, chargebacks, and all cost of goods sold. So it's a real return on investment type number. It's not just taking the revenue and dividing it into the investment. On a 3-year basis, that looks like 4 to 4.5x return on our advertising investment. So healthy returns on investment.
I'm thinking to myself, especially for those that don't have insurance coverage. I mean, $39 for a visit to the doctor to get a checkup doesn't sound too onerous to me, right? I mean,
No, it's not. Most of our patients do have insurance. Most have a high deductible health plan. So 60% of America has a high deductible health plan, which means that their deductible is usually in the thousands of dollars per year. So insurance isn't paying much anyway. Now, look, I mean, even if you have a great insurance plan and your primary care visits cost you nothing, we have other benefits. We have the prescription drug discount program, preferential pricing on diagnostics, where oftentimes the cash pay that we have on lab work is much lower than what you'll pay through your insurance. And then look, we've got a few other benefits within the platform. All your medical records are there. It's super convenient. It's a one-stop shop. I mean, you've got pharmacy, which we can drop ship to your door. We can also dispense to your local pharmacy for the non-lifestyle stuff where we're not actually making money on the sale of that. Diagnostics integrations. We have related medical content that we can serve up to people. And then there's symptom checkers and a few other things in there. So, and then the biggest thing that really is lacking in the primary care world is a lot of folks, if you had to get a primary care appointment and you don't already have a primary care physician, or even if you have one, oftentimes the wait time can be a month, 2 months, sometimes even longer. We typically can provide 48 to 72 hours access to a new appointment for a new patient. An existing patient, message us. We can get right back in touch with you. We have a full-scale call center in South Carolina that can get either your physician or another physician if there's an urgent need. So it really is a very sort of, even though it's virtual, it's a high-touch environment with a lot of points in which you can reach out to us. And we break down the walls that exist with a lot of the accessibility, particularly as a lot of the large hospital systems are consolidating a lot of private practices, which is only making accessibility more challenging.
to me, especially after like the COVID scare we just had, right?
Yep.
If you're not like, if you don't have something falling off of your body or you're not in like real serious pain, it just seems like a much safer way to go to get your checkup than walking into a place that's got who knows what in it, right?
Yeah, it's also very convenient, and yeah, most things can be handled through telemedicine. And it's a lot of saying, we sometimes say internally, it's like having a doctor in the family. I mean, you've got someone that you can reach out to there, and look, $39 a month is not a lot. We actually started the primary care business at $15 a month. We discovered some pricing elasticity in that business, so there's been a lot of demand for it. There's always going to be people that are obviously not going to be patients, but we've essentially gone 0 to 200,000 patients, and we started telemedicine in 2019 with just an ED business in December 2019. We had $500,000 in the bank then. We were an OTC company, and today we're obviously we're a profitable large scale provider in a rapidly growing market.
So you had some burn for a while, but the cash burn is down. And
it's down. It's, as we sit here today, it's basically behind us. In the first quarter, we came out publicly. We're going to announce our second quarter earnings August 9th after the bell. But look, in the first quarter, if you backed out some timing in the AP, we were doing a deal with Avenue in the first quarter. So there was some timing shift in when bills were paid. They were for the fourth quarter and were instead paid in the first quarter. You back that out, we only burned $678,000 in the first quarter. That's if you back out our debt service and you back out our CapEx and obviously our operating cash flow. Look, we're at a point now where essentially, we finish most months with the same amount of cash that we started the month with, or somewhere right in that ballpark. So, we're in a good situation. We're not in a situation where we need to go out and raise capital to continue to expand this business.
And that's, in this market right now, in this climate, means everything. Cash is king, right?
Yeah, exactly.
And you're sitting in a good position. The stock has had a meteoric run. I mean, from $1.70 up to $5. That's not a bad return. Can't blame anybody for taking some money off the table after a run like that in a very short period of time, right?
Yep.
Now it's just a matter of where does it find support? Where does it find some stability? And you have to ask yourself, what's the risk reward? Does it go back to 5? Does it go higher than 5? What did you say you had in patients? 200,000 right now?
Yeah, we have 200,000 active patients. We're growing double digits every year.
And how big is the opportunity, Mark?
I mean, look, the opportunity is a multi-$100 billion TAM. I mean, at the end of the day, if you look at the lifestyle verticals that we go after, plus primary care, even before weight loss got introduced this quarter, most public sources will say the addressable market was 300 to 400 billion. Some addressable sources say that the weight loss market now is 200 billion on top of that. And it's a growing market. So the TAM is tremendous. I think nobody really knows exactly how big it can be. It's also a TAM where there's not going to be one winner. There's going to be multiple winners. It's just that in every large market, there always is multiple winners. We're not necessarily going to be the largest company out there ever in direct-to-patient healthcare, but we're certainly striving to be within the top 3 to 5. And we're actually have probably the best margins of anyone right now. So we're looking to also do it smartly. I mean, to get to the point that we're at, we've raised probably $60 million in total in the company's history. Most of our competitors have raised $500 million to $1 billion plus, and we don't need to raise more capital. So we think we're in a really good place. We've got 32 million shares outstanding. Most of our competitors have 300 million or.
Okay, so that's a key. I want to highlight that for a second. 32, is that fully diluted?
32 is without warrants and options. You put in warrants and employee options, you're at about 40 million.
All right, so still
41 million.
40 million is like anything under 100 million in my mind is, I would consider a small float, right?
Yeah. And insiders own about 25% of the company.
Okay, so you take 20% of that number, the 40 million, right? Now you're getting down there. There's not a lot of shares out there, right?
Yeah.
That's why you saw this big spike in a very short period of time.
Yeah.
Right?
No, definitely. I mean, of the 40 fully diluted, about 30 is out there. About 25% is insiders. And insiders have actually, I think we've had only one sale in the history of the company, but a lot of buying along the way.
Which is something I love to see, right? If I'm building a case on why do I want to look at owning this company, this stock? Insider participation it's not that it's a guarantee, but I could say that there's only one reason why people buy. There's a whole bunch of reasons why people sell.
Of course.
When it comes to buying, it's usually one reason. They think it's undervalued. And if it's an insider, who knows better than them that it's undervalued, right?
Totally agree.
All right. So I think, I don't know how many people are familiar with LifeMD. You just go to the website, LifeMD.com.
Yeah. So LifeMD.com is our consumer website for the virtual primary care business. Like a lot of consumer sites, we don't want to deflect the consumer to IR, but for investors, the investor relations website is ir.lifemd.com. That would be the best source of information for an investor.
Which is right above my head right here.
Yeah.
LFMD.com. Yeah.
www.lifemd.com is the consumer site if you want to poke around the consumer virtual primary care site. And within the lifestyle businesses, we've got some other brands, RexMD being the largest in men's health, and one of the largest men's health brands in the U.S. But for investors, ir.lifemd.com, we've got all of our recent all the SEC filings are in there, the corporate presentation, supplemental, and recent press releases. And today we have 3 covering analysts, BTIG, B. Riley, H.C. Wainwright. Likely we'll have additional coverage in the future. All the analysts have price targets well above the current price. So yeah.
What does the landscape look like for maybe, I don't know, tuck-in acquisition for you guys? For maybe somebody that,
Yeah, no, we're an organic grower. We're not going to go out there and start buying other companies unless there was something that could really help us accelerate the primary care business significantly and was on sale. That's the only way we would do that. But we're an organic grower. We're very good. We've done 2 acquisitions in our past, but we don't really have the need to go. We've actually done better through organic growth. Almost all of the company's revenue today, which will be about 150 million this year, possibly higher. We think we've been pretty conservative, at least with the top line guidance, is inorganic. So that's our focus. Look, long term, the more likely scenario is our company probably gets taken out at some point longer term. I think that ultimately that's the play. We're probably not public 10 years from now. Whether that's 2 years from now, 3 years, or 12 months from now, who knows? But I think that there's a lot of value ahead for us, and we've had insiders buying stock at prices well above the current level, so we all think we're going back to the double digits at some point, and we think we're going to create the fundamental value to justify that. But the heat of the pandemic, everything that was at home got overbought. I mean, at the end of the day, that's just what happened. But if you look at us, our valuation, even after the run-up, was significantly below our peer group, and our fundamentals have only gotten significantly better. So that's why, we think there'll be a lot of value ahead in the couple of years ahead.
yeah, no, I look, what I think is interesting about the chart right now is just, I mean, you do have a little area of support right here at like 350, right? You've got a couple of things. You got the 40 EMA, and then you've also got this little support area right there. So 350 could act as, this could be it. I mean, this could be the support, and then you get another stair step up, right? Stocks typically take the stairs up, take the elevator down. That's just the way it works.
Yep.
So, right?
No, that's definitely true.
If by chance, I don't know, the Fed gets stupid and it's not going to matter that your stock isn't going to be impacted by the Fed. Every stock, 90% of stocks are going to follow what the market's doing. So if the market tanks because the Fed does something really, really stupid, I think the next area of real significant support for the stock is right around $2, right? Which is because you've got a really defined line of resistance there, which I think now would act as very, very strong support. So I'm not saying it's going to, I'm saying if the markets roll over and people panic, could it go to 2? Yeah, but that would be, in my head, an excellent opportunity to add shares, right? I'm not telling anybody to buy the stock. I am telling people this is a heck of a good story. It sounds like you turned the corner from cash burn to at least break cash. Are you making money? Are you profitable?
Yeah, we're profitable on an EBITDA basis. If you back out, true free cash flow, backing out CapEx and, some of our debt service, we're essentially break even at that point. But pure, what would be shown as adjusted earnings for a public company, which is really the EBITDA, backing out the non-cash stuff, we're profitable. We turned profitable in the fourth quarter. We actually guided to that 12 to 18 months ahead of that. And we've been, in the last 2 years, I joined in Q1 21, every single quarter we've had sequential improvement in profitability. So not only are we profitable, we expect to continue to see growth in that profitability. I mean, inevitably there'll probably be some quarters with flat EBITDA because we want to balance that with growth, and we've got some really tremendous opportunities in front of us. But the long-term goal here is over the next 3 to 5 years, 25 to 30+% annual growth and 25 to 30% EBITDA margins within that time frame.
Okay. And I mean, the biggest part of your expense would be, I would think, marketing, right? I mean,
it's marketing, yeah. And at the end of the day, one of the ways we've been able to aside from our gross margins improving as we scale, marketing expense about 12 to 15 months ago was 100% or slightly below that of revenue. It's currently about 50% of revenue, and we think we can get it to about 30% of revenue. And a lot of that has to do with we have a retention-based model. And, as I mentioned, 95% of our revenue is recurring. About 18 months ago, only 20 to 25% of our revenue came from existing subscribers, so people that were existing patient subscribers prior to that quarter. Today, 70+% of our revenue is coming from just rebilling of existing subscribers. So you have this predictable stream. I mean, everyone obviously has attrition in these models, but a predictable stream that's growing over time, and we continue to go out, market, and acquire new patients, which adds to that predictable stream. That's what enables us to really build a profitable business in the long haul. And there's not a lot of extra cost that's required to do that, and you can level out your marketing spend. And obviously,
I think, besides this being a good idea for a potential investment, I mean, anybody watching that doesn't have healthcare or is in need of a healthcare program, I mean, this is worth checking out for that as well, right? I mean,
yeah, most definitely. I mean, we have patients across the country, the 50-state clinical network, so we can service you in any area that you're in. And, we service a wide swath of patients, age-wise, socioeconomic wise. As I mentioned, many of our patients have coverage. And look, if you're looking for help in any of the lifestyle areas, the men's health, or Rex helps, or hair loss, or dermatology.
I'm thinking of Zip Health, GoodRx. There's all these different programs out there. What was the last?
Yeah.
Fresh Friday was the last thing that I got.
A lot of these programs, we're one of the only programs out there that our telehealth platform can cover you A to Z from a healthcare standpoint. I mean, look, unfortunately, if you have cancer or heart failure, obviously you need to see someone in person. But most people are not in that situation. And for a lot of your general healthcare needs, and even look, cold, flu, migraines, I mean, the whole swath of things, we can cover you. And we have a great physician network. Our doctors regularly have 4.9 and higher reviews. Most of our physicians have been hired from referrals from our existing physicians or nurse practitioners. And our platform is set up to focus on relationship-based care between provider and patient, not set up to just be these virtual visits where you never see or talk to your physician again. And people like that. And I think that that's helped differentiate us and set us apart. And we're not pill pushers either. I mean, at the end of the day, if you're in primary care, the physician is salaried. They get paid, whether you take a prescription or not, and their best interest. And frankly, any incentives that they have is based on patient satisfaction and volume that they do. So they're not incentivized to go out there and do the wrong thing for you either.
You got anything on the horizon, Marc, that you feel could be a catalyst for?
Yeah, couple things. I think one, weight loss is probably the biggest near-term catalyst. Obviously, the GLP-1 market is really hot, and there's not a lot of ways to play it. I mean, at the end of the day, Lilly and Novo's multiples are crazy right now. They've had tremendous run-ups, and they're much higher than the rest of the pharma market. We're one of the only companies out there that's public that has a rapid growth weight loss business, and while it's anchored with GLP-1s, as I mentioned, we're not just selling GLP-1s, we're providing holistic healthcare services when it comes to weight loss. And it's one of the reasons why we have these B2B partnerships, as I mentioned before, where a lot of these companies that do nutrition and coaching and are really looking for a clinical angle. I think Weight Watchers just came out and said they're even going to be offering some of these clinical services after their acquisition. There's not a lot of ways to play this, and it's a massive market where we are really asserting ourselves. And even though we only launched in Q2, we already have thousands of patients for weight loss, and we expect to grow that very significantly. So I think
do you have an affiliate program at all? I mean,
no, we don't. We've done some affiliate marketing. Our marketing team definitely does do some of that. We're pretty mindful. We like to control a lot of the avenues. We do it where appropriate. We're going to probably start some referral programs in the future, which, we're looking to do, but, we've been really effective at growing through offline and online media and then providing great care and having people refer other people to us. I mean, that's just been
That's what I'm thinking. This is the kind of thing. There's word of mouth. Somebody goes and has a good experience, right? In and out, very convenient. Got the prescription you needed, and no, it was painless visit to the doctor, right?
Yeah. Yeah, no, most definitely. So look, that's one really big catalyst. I think additional enterprise partnerships, and we've got some very exciting ones I mentioned. Like right now, there's a couple of other exciting ones in the pipeline. Those have the potential to turn either into a larger scale partnership nationally and not just smaller regional programs, or into potential license deals. I mean, obviously a license deal would typically carry pretty significant fees and recurring revenue to the company and really help us branch into another area where we're licensing the platform. So that's number two. Number three, I just think the ongoing growth of the profitability of the company. I mean, at the end of the day, between our healthcare business and our non-core subsidiary, Works Simply, the profitability is just going to keep growing, in this company. That should be a catalyst. And then four, I think when we're out there publicly announcing that cash burn is gone, we're very close to that right now. But it's on the horizon and we're well on our way to doing that. We got it for the middle of the year. We're definitely on track with that. I think that becomes another catalyst. And look, the last one, we try to be conservative with our guidance. I think probably more conservative with the revenue than the bottom line. And we want to balance the two, but we're very focused on growth. I think, look, there could be, the potential that as we continue to take advantage of weight loss, we grow ahead of our plans in the lifestyle business that, look, you never know, guidance could get taken up or we could have upside surprises there as we head into the back half of the year, just given the trajectory we've had in the first half of the year.
Excellent. All right, Marc, listen, I want to thank you for coming in and sharing us the story. I think it's a good one. I think, you got to ask yourself, what's the risk reward here, right? What's the risk reward potential? And I think the risk reward potential is great in favor of taking that risk. So, at the very least, put it on your watch list is what I would say. Go to their IR, site, sign up. You guys have investor alerts, right?
We do. You can sign up right there. If anybody has any direct questions, I speak to all types of investors, both institution and retail. I'm Marc, M-A-R-C, at LifeMD.com, LAFDMD.com. Don't be afraid to reach out. I know not every company does, but I make sure that we respond to every investor inquiry.
The CEO, how long has he been there? Is he the founder?
Co-founders. He's one of the co-founders. So the company, Justin's been here since 2018. One of the co-founders. He was one of the initial investors in the business, and he owns about 8 to 9% of the company. And he takes a low salary. He takes basically less than $300,000 a year in salary and works mostly for stock. Look, he's very vested. The other co-founder, Stefan's our chief innovation officer. He also takes a low salary and mostly works for stock. He owns about 5% of the company. And, so we've got a very vested, management team. The board mostly is on the board for stock. Look, our board has a pretty impressive roster of people that actually do make an impact in the company. Bobby Jindal, the former governor of Louisiana, is on our board and instrumental with a lot of our healthcare relationships. Naveen Bhatia is a former senior executive from Blackstone, went on to be an entrepreneur and been on many public and private boards. He's on our board. Roberto Simon chairs our audit committee. He's a former CFO of WEX, which is a $10 billion NYSE company. Now he's the CFO of a large private company. We have Joan Rivera, who's one of the senior and head physicians at Boston Children's Hospital. And we've got a few other really top flight board. Oh, Will Fabo, who's the CEO of Optimize RX, recently joined our board also, which is one of the top HCIT small cap companies. And the reason we've been able to attract that talent on the board for mostly equity, we pay our board minimal in cash. Some we don't even pay anything in cash, is because they believe in the upside of the company. They all did a lot of diligence in the company. So yeah, I'll probably just leave everyone with that.
That's the other thing to look at, right? So remember, I said building a case. You know, who's joining the board? I mean, what is the quality of the team that is assembled here, right?
Yeah, exactly. And none of these people typically join smaller micro cap companies because they usually don't have to. They're here because they obviously believe in what we're doing. You know, and as I said, if anybody has any questions, Marc and me are at lifemd.com. Don't hesitate to reach out. We obviously speak, and I'd say, you know, probably post the Q1 earnings, which were very strong. And as we've gotten bigger, we continue to see more institutional interest.
Which quarter is typically your best quarter, and which is your worst?
We don't have seasonality. I mean, at the end of the day, one of the big things that we did this year is, in the past, like a lot of high growth companies, it took a while for some of our analysts to get their head around what the company what they should be estimating for earnings and top line. And even when we gave guidance, a lot of them would just assume something higher because everybody wants to push, you know, to kind of make as much as possible. But I think we're in a good place now where analysts are looking at things on a reasonable basis relative to our guidance. Took a little bit of time to get there, which is why I think we're starting to see stronger performance relative to their estimates. It just took some time to calibrate that with them.
Yeah, if you look at the chart and you look at most of the small and micro cap stocks, and I don't care which one it is, over the last same time frame, your chart looks very different from most, right?
Yeah. Look, we looked at our peer group and we calculated we had the highest return in our peer group when we looked at it. So, you know, there's about 10 to 13 companies, depending upon how you look at it, and healthcare services or healthcare technology that were either micro or small caps. And yeah, we were the outlier. We definitely were the outlier. And look, the fundamentals back it up. I mean, this isn't early 21 where, you know, in early 21, this company was doing about 35 million in revenue and losing $50-60 million a year. Now we're profitable and we're going to do 150 million in revenue. So valuations probably don't get back to what they were at that time, but they obviously swung way too far in the other direction, particularly for our company. And we've now got a strong balance sheet. We didn't have that last year. We strengthened it this year.
Time, Marc?
Since Q1 21. That's really, we solidified our management team between 2020 and the beginning of 21. We haven't had C-level turnover other than some early guys that just really weren't equipped to run a public company in the early days. But co-founders still here, and the rest of the team has continued to be here without turnover.
Oh, it's awesome. I think it's a fantastic story. Thank you for taking the time to come in. And when you have another catalyst, we'll have you back and kind of give everybody an update.
Yeah, sounds great.
All right. Hold on one second. I'm going to stop recording on this.
Hey there, folks. Thanks for tuning in and listening to yet another interview here at Alpha Wolf Trading. Today we had Marc Benathen from LifeMD, ticker symbol LFMD. If you enjoyed today's interview, do us a favor, give us a like. How about giving us a share? And while you're at it, why not give us a follow? Until next time, stay safe. Alpha Wolf Trading wishes you the very best of success.